and strategies and criteria for trading. So again, good afternoon. Again, I'm Dave with the Compass Options Trading Room and the Alert Service, and we're going to get started. So welcome everybody. All right, so this is just the headline here. What we're going to be doing, we are going to be talking about some basic options trading as well, the information about options, and we'll talk about my trading room and the Alert Service, as well as the Compass system, which is a piece of software that I run on Thinkorswim. I don't trade on Thinkorswim, but I use the software on there to identify when institutions are in there. All right, so here we go. Again, just kind of a fancy graph to show the graphic to show the SPY super system. SPY super system uses the Compass system, but it's much more. These are quick trades that I'll show you how we use those inside the room. Okay. All right. So the first thing I have to do, of course, is the disclaimer. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. All right. If you have any questions, by the way, along the way, just put them in the question box. If you have a question that I can't answer, you need to talk to one of the like Rory is at Right Line. He can answer some of the other questions I can't. Just put your name and phone number in the chat box or your Skype username, and he'll follow up with you later on to answer those questions. All right. So it's just kind of a graphic of what the Compass system looks like. We call it the SPY super system. Basically, we track institutional money flow with the system, which is critical. As I'm going to tell you in just a minute why it's important to be able to do that. It's more important. It's basically critical to be able to identify when institutions are in trades and when they're not. And this is what the Alert Service looks like. You get your alerts directly on your phone. I put them into usually it's in the room, and I put the alert out at the same time. I take all these trades, by the way, all the trades that I talk about in the room, and all the trades that I alert on. I've taken the live money in my live account. I don't just call them out and not use them. I trade all of these so I know. People will ask me, do you know we're down money on this trade? And I'll say I'm fully aware of it. I'm in the trade. I'm in all of these trades. But this is what it looks like on your phone. Again, I'm a member of the Alert Service. I signed up just with my name in it so that I'll get the alerts as well. So that way I can track how long it's taking to get there. And I usually get mine in about 15 seconds, 10 to 15 seconds normally once I put the alert in to send. So first thing I want to talk about, and I talk about this in all my webinars, because this is really an important thing to understand. What drives markets? What drives trends in markets? What reverses trends in markets? Markets made up of two main elements. These little marbles here are retail traders such as myself, and I suspect everybody else here is a retail trader. We are basically, we have no ability to move the market. We can trade against each other, but when we're only trading against each other as retail traders, without institutions being in the trade, then all we're doing is creating a lot of chop and a lot of chaos in the market, and it's very, very difficult to make any money in those kind of situations. Now, the big marble here, this is the institutions, and these are the folks that drive the market. Now, let's understand exactly who institutions are. They're investment banks like Goldman Sachs, Morgan Stanley, JP Morgan, all the big investment banks. And investment banks have trading desks, which is actually humans that are trading through computers, through their own computers. But they also have algos, or basically programs that run automatically to buy and sell, invest, trade, and also just trade, short-term trades. So they'll this is what institutions do. They're the ones that drive the market. Now, the institutions aren't just the investment banks. They also include hedge funds. I mean, there's hundreds and hundreds of hedge funds with billions of dollars to trade, so they can move the market. The hedge funds can, and then you add on top of that pension funds, big pension funds like state employee pension funds, police pension funds, firemen pension funds. These are huge entities of cash that they trade. And one other is it would be mutual funds. Vanguard, T. Rowe Price. These are more huge companies that have massive amounts of money, hundreds of billions of dollars to trade. That's what makes up institutions. So when the institutions are driving the trade, that's what we want to know, because we want to be in, when the institutions are in, we want to be in there, and we're going to take our money from the other retail traders who don't know what we know. They don't have the information we have. They don't have the system we have. They don't have the methodology we have. We're going to know a lot of things that they don't know, and we're going to take money from them. We're not going to take money from the institutions, but we're going to be following the institutions. So this is really important to understand. So this is what we have to be able to identify when we're taking trades. All right, so I have couple of basic rules to trade by in the room and for the alert service. First thing is we trade the best and skip the rest. We're very selective about the trades that we take, very selective. We don't take a lot of trades. We take, you know, a small number of trades. I mean, enough, but a small number of trades. And we skip trade the best and skip the rest. This basically says we're only going to get into a trade that lines up the way we want, is at a level that we want, and institutions are in that trade, you know, either buying or selling. Second thing is it's important to remember, our objective is not to make trades. Our objective is to make money. This sounds kind of simple, but one of the big drawbacks that a lot of retail traders have is when they're trading, they feel like since they're a trader, they need to be in a trade all the time. They don't understand that not taking a trade a lot of times is the best trade. Sometimes you just have to kind of sit on your hands and watch and wait for the lineup to come to you. I mean, if the institutions are not in trades, you may have to watch for a long time for that trade to line up. But that's the important thing. You do not want to be in a trade just to make trades. So this is basically meant to try to make traders understand that patience is critical here. Very critical to have patience. Now, as a profitable trader, a profitable retail trader, we need an edge over other retail traders. Our edges are that, but I'm going to explain these. We have the right line compass system. This right line compass system is a piece of software that runs on thinkorswim that will help us identify when institutions are in trades and when they're not. And then we trade what's called relative strength and relative weakness. Now, this should not be confused with RSI, the oscillator RSI. Relative strength means how is our stock moving in comparison to how the SPY is moving. So you look at a SPY chart, a 5-minute SPY chart. If the SPY is moving sideways and down, and you've got a chart stock that's stacking green candles, you've got relative strength, and vice versa. Market's moving sideways or up, and your stock is moving consistently down, you've got relative weakness. This helps a lot in the trade, because if you get in a trade and you're trading with relative strength or relative weakness, and the market reverses from the direction that it was in, then you're not going to take as big a hit as you would if you were in a stock that didn't have relative strength and relative weakness. So that's very important as well. And then we try to trade with the market trend if there is a trend. Sometimes the market's choppy, but a lot of times there's market trends, and we'll follow market trends. And the fourth thing is we try to buy near support and sell near resistance. In other words, don't chase. When you see stocks that are taking off, it's just it becomes what's called FOMO. You have a fear of missing out. The stock takes off, stacking green on top of green on top of green, and you feel like I'm missing out in the stock. I'm missing out on all this profit. So you jump in, and typically you jump in somewhere near the top, and it reverses on you. If you had just waited for it to come back down to support and then bounce again, that's where you want to be. So buy near support and sell near resistance. Steve, change your last name to virtue to develop patience. Patience is a virtue. Okay, so the compass system, we're going to talk about a little bit. This software that actually runs on thinkorswim on Ninja 8. It's going to identify the highest probability setups while sidestepping the setups that look good but will fail more often than they succeed. This is really important. If you're just looking at technicals, straight technicals, without knowing if the institutions are in it or not, you're going to get trapped in some trades. The compass system does this by identifying when the institutions are driving the move and when they're not. This is really critical to know. And the compass software, it does this by analyzing complex trading data, which I'll go over a little later, and displays the results in easily identifiable visual format. So this is really important because it's complex information to know whether the institutions are in the trade or not, but it needs to be presented in such a way that even new traders can understand whether the institutions are in there or not. And that's what makes this so important, is the visual element makes it possible for even new traders to find high probability trades. And you'll see that when we take a look at the compass system. This is kind of a graphic display of what the compass system looks like on Thinkorswim. Okay, so again, this is how we get an edge over retail traders. We're only taking trades that are being driven by institutions. I've said this about 3 times already. I've tried to force this to people to understand that it's important to understand if institutions are in the trade or if they're not. We trade stocks that have relative strength or relative weakness versus the SPY or the Qs, and we trade in the direction of the overall market. This is a big, huge edge for us. And this gives us an edge because our trades are going to be supported by institutional buying or selling. They'll be outperforming the index, and they're going to be moving in the direction of the overall market. 99% of retail traders have no idea whether institutions are in the trade or not. Absolutely no idea. They don't know how to trade relative strength. In fact, they don't even pay any attention to relative strength. They're watching things like MACD crossovers and RSIs. They don't know about judging relative strength and trading relative strength and relative weakness. So you're already got this huge edge up on other retail traders as long as you know these kind of things. And of course, trading in the direction is important if there is a direction. So again, that's how we have an edge over retail traders, and that's what we want. That's how we make money. And it's trading is a war. You're trading against other retail traders, and if you go to war with tanks and bazookas, and they're coming into war with pea shooters and pop guns, you're gonna take money from them. And it's a kind of harsh thing to say, but that's what trading is. You're trading with better information than they have, and you're going to take money from them. This is kind of a high probability trade setup, what I call a funnel. This funnel is basically, this is a virtual funnel. This is the thought process I go through when I'm looking to see if a trade is a high probability trade setup or not. First thing I do is I look at the daily chart. This is really important to trade off the daily chart first before you go to your 5-minute chart, because when you get into a trade, you want to be able to stay in the trade long enough to withstand any kind of drawdowns, and even take it overnight if necessary. And the way you do that is by, if you want to take a stock long, make sure the daily chart is bullish. Don't be taking a stock long that has a bearish daily chart. So the daily and the 5-minute need to align. Once I know the daily chart's bullish and I want to go long, then I use the 5-minute chart to find my entry, to get into it at the best level, a support level or a resistance level, etc. But this is important. I always start with that. A lot of people don't even look at the daily chart before they take a trade, and it's really, really important. Okay, so we trade with the trend, both the stock and the market. Then we look at the compass indicators. These compass indicators need to tell us that the institutions are buying for a long and selling for a short. If we can't identify that they're in the trade, we don't want to trade it. Simple as that. This needs to be true, and this needs to be true for longer term intraday trades and swing trades. And then we trade relative strength and relative weakness. As I've said, this is really important. And then you want to enter near support or near resistance. Now, if you're trying to get into a trade and the stock has maybe run away a little bit, you can just put an alert at a support level or resistance level, alert yourself when the stock gets to that level, then go back in and look at it and see if it now confirms as a trade you want to take. Okay, so that's the funnel, and this is the basically just the verbiage of what that funnel is. Stock to be traded should have a daily and 5-minute align. Compass indicators must align to the direction of the trade. These two things alone are going to put you way ahead of 99.9% of retail traders. They don't know this, but even if they know it, they don't know how to find it. So that's really important. All right, and last thing I talk about here is have patience. One of the things I'll talk about is on the 5-minute chart, there's a level called the VWAP, the volume weighted average price. This is something that institutions all use, and it becomes a critical support and resistance level that we use all the time in our day trades. And then have patience is the last thing. It's extremely important to have patience. I preach this all the time to the room. Sometimes they'll be sitting and watching, and people don't want to sit and watch. They want to risk their money. And a lot of times not taking a trade is your best trade. All right, so the strategies that we use in the room, these are the main strategies I use. I obviously buy straight puts and straight calls. I do debit spreads using weekly options expiration. I do time spreads, what's called a calendar spread. I do these over earnings. This is an earnings trade. It's the only earnings trade I take. It uses a methodology called a time spread or a calendar spread. And what we do is we capture the volatility crash. This is a non-directional trade. After earnings, I do not care whether the stock goes up or goes down. I don't care. I'm more interested in the volatility that is going to come out of that once the earnings comes out. And I have a whole video on all of this, on the time spreads and all of the strategies that we use in the room. I also do what's called a weekly ATM strategy to capture premium. This is where we sell puts on a stock that's neutral to bullish. We sell puts on it week after week after week while holding a longer term dated put, a long put further out in time at a lower strike price to protect that trade in case the stock turns and goes against us. And then I do credit spreads to capture premium. These are fairly common. I think anybody that trades a lot knows about credit spreads. We do these as well. And the SPY super system, which is one I'm going to get into some detail on. This is for very high probability trades to catch the SPY, the Qs, or the IWM. I do this in the room. I call about it in the room, and we talk about this a lot. These are quick trades. I do not alert on these trades. I can't alert on these trades. They're much too quick. But they're a good way to make trades while we're waiting to find a longer term trade that we want to take. This is a good way to make trades to basically bring in some money. And it's also a good way for folks who are in my room who can't stay there all day, can only come in for an hour or two in the morning or maybe an hour or two in the afternoon. You can trade the SPY super system and do very, very well just by being in the room for limited periods of time. So that's very important. Steve points out price action, need to understand it. Yeah, you do need to understand price action. But what's driving the price action is extremely critical. All right, so those are the strategies that we use on the alert service and in the room. We'll get into the SPY super system a little bit later. So talking about the alert service first, the alert service, it's designed for day trades and short-term swing trades. These trades are going to last a few hours in the instance of a day trade to up to maybe 2 or 3 weeks. Anything that's a swing trade, to me, a short-term swing trade is overnight up to maybe 2 to 3 weeks. 3 weeks is probably the outside. Most of them only last, if they go overnight, they'll only last 2 or 3 days. They don't last a long time. It's designed for traders who can't watch or don't want to watch the market all day. And you're going to get real-time alerts on the highest probability trade setups. And again, I take all these trades, the trades that are on the alerts, those trades will be in the room as well. We do other trades in the room we don't alert on for multiple reasons. One, it's going to be too short a trade, not giving the alert service members time enough to react to it. If I take a trade at 3:45 in the afternoon, that's too late because by the time the alert goes out, the members won't have a fair chance. So there'll be more trades in the room than there are on the alert service. But anything that is on the alert service will also be in the room. And we identify these high probability trades, as I've said already multiple times, by identifying institutional involvement. When the institutions are in a trade, that's the ones we want to be in, other criteria being equal. And then we look at the market internals, which is the number of volume of stocks moving up versus the volume of stocks moving down. And we'll take those trades. Now, we will take trades that just have institutional involvement if the market internals are neutral. They don't, for a bullish trade, the market internals have to be neutral or bullish. They just can't be bearish. And then we do deep diving into more technical analysis to identify these trades. This is an equity curve for the alert service back from March 23rd. And this is based on, and this is just a way to judge the results, but basically this assumes $2,000 put into each trade. This is what the results have been since March of 2023. So a lot of trades, but a nice direction. And we get, see, we have some losses we have month obviously losses just like everybody else does. All right, so we're going to talk about options here. I want to get the options part of this up early, so because I know some people have come here to find out about the options. So I want to, before I get into the results and the buy super system, I'm going to go over about options. Right, so this is pretty basic stuff here. If you're used to options, this is gonna be familiar to you. But people who don't, I try to go over the basics here. So this is what's called an option chain. This is for Bristol Myers. It's a few months ago, but basically I'm going to just go over the elements of an option chain. So a couple things we have here. First of all, on the left side, these options here are the calls. These are what you would buy if you were going bullish. These are the puts. This is what you would buy if you were going bearish. Right, so this is the call side. This is the put side. Across the top here, these are expiration dates. Bristol Myers has weekly expiration date. A lot of stocks only have monthly expiration dates. Stocks like the SPY and the Qs, the IWM, some of those stocks, some of those indexes, they have daily expirations, what's called 0 DTE, or 0 days till expiration. But this Bristol Myers has weeklies, and this is all the expiration dates across the top here. Now, down the middle, this is the other key thing. This is called the strike price. So when you buy an option, what you're going to do is you're going to buy a particular strike price, a call or a put, a particular strike price for a particular expiration date. That's what makes up an option. All right, so these are the strike prices. Now, notice on here, this is Bristol Myers. Notice the price at the time was $53.79. And you see this highlighted line right here at the 54. This is what's called the in the money or at the money. This is an at the money strike price. So this is the closest strike price to what the stock's trading at. So this is the strike. 54 is an at the money strike. Anything below that is called an in the money strike, because the stock has already gone back past that price, and the stocks above that are called out of the money strikes. So we'll just take a look at the at the money strike right now. In here we've got a couple things. We've got what's called the bid and the ask. This is what's called the bid-ask spread. So if somebody is bidding for this stock, they're trying to buy the option, they're bidding 61 cents, or $61 a contract on this thing. And the ask, they're asking $66 a contract, for 66 cents. So this is the bid-ask spread. Typically, you're going to get filled somewhere in the middle. You're typically not going to be able to sell it at the high and buy it at the low. It's usually going to be somewhere around 64, 65 cents. Something like that. But anyway, this is the bid-ask spread. Now, the other thing that I've got on here is called delta. This is delta. See, this delta says delta of 52. And we're going to talk about what the delta is, but the delta tells you how much that option is going to move relative to how much the stock moves. So if you've got a delta of 52, that means if the stock moves up by $1, your option is going to go up by 52 cents. So a stock that moves $1 is going to move your option from 52 cents. It's gonna, if it goes up $1, it's going to go up by 52 cents. So it's basically 1/2. Now, if you notice the deltas here, you see it's 52 on the calls. This is the 54 call. Here's the 54 put over here. Right. So if you were buying a put, you'd be looking to buy it between 79 and 83. But notice the delta on this. It's 48. This is 52. These values add up to 100. The delta is 100. All right, so that's your delta, which is the movement the option is going to make. So it's good to know when you take an option what the delta is, so you have some idea how much that option is going to move if the stock goes in your direction. Right, so there you go: strike price, expiration date, calls on this side, puts on this side, bid and ask spreads here and here, and these anything below on the call side. This is in the money calls, this is out of the money calls. On the put side, this is in the money puts, this is out of the money puts. Price hasn't got there yet. All right, so that's a basic option chain right there. All right, so this is it's the same thing again, exact same stream, but what I put on here is I added one other thing. It's called OI in volume. This is open interest in volume. Right, so it's really important to understand the open interest in volume will tell you how easy it is to get in and out of a trade. If there's not very much open interest, then it's going to be harder to get out, because there isn't a lot of contracts for you to, if you're trying to sell, there isn't enough people out there to buy them from you. So this what you've got here is the in this particular case, 617 is the volume and 11,867 is the open interest. I don't know why they do this like this, it's the other way. But 11,867 is the open interest, and this is the volume for the day. This is the number of contracts that's traded at that strike price so far today on Bristol Myers, both bought and sold. All right. So the next thing that you look at is the 11,867, and this is what the open interest is. The open interest is the number of contracts that were outstanding at the beginning of the day. All right. The 617 is not included in this 11,867. This is updated at the end of each day. So when you go into the day, this is going to tell you what the open interest is, and then at the end of the day, it'll be recalculated again. So this 617 is not included in there. This tells you how many contracts have been bought or sold today. All right, so that's important on that. It's good to know the more open interest you get, the easier it is to buy or sell. And you can see the open interest is high on these. You're never going to have any trouble buying or selling Bristol Myers puts or calls. All right. Steve, you're asking about volume and highs and lows. Are you asking me a question on those? Or just pointing out that that's important? You're asking a question. I don't know what to tell you. I mean, volume counts. Yes, we look at volume. We look at highs and lows on price action. We'll get into price action here in just a little bit. Those numbers on here. Yeah, these are the volume. Yeah, but I mean, the highs and lows, I mean, you can get a lot of information off these option chains. I haven't gone into all the detail. I mean, there's a lot more information you can get off the option chain, how high the options been for the day, what the low is, et cetera. But I'm not putting all that stuff in here. That's somebody who trades options is gonna be aware of that. But this is the basic stuff that you need to know to trade options. All right, so this is kind of the topics I'm gonna go through for the options here right now. What are options? What makes up option premiums? We're going to talk about intrinsic versus extrinsic value. This is pretty important. We're going to talk about Greeks. We've talked about one of them already, the delta. We're going to talk about strike price and expiration date. What's the best combination of those to use? Volume and open interest we've covered already, and then the primary option trades that we take in the room and on the alert service. So basic, and then we're going to also cover strategies. If you like a stock bullish, there are certain option strategies you can use. If you like it bearish, there are certain option strategies you can use. If you're neutral on it, you don't know whether it's going to go up or down, there are option strategies for that. And then I'll talk a little bit about the trade setups. Won't get into a lot of detail of the trade setups because they can get fairly complex. All right, so what are options? Well, you probably know there's calls and puts. You can buy the calls or you can sell the calls. You can buy the puts or sell the puts. Typically, we stick with buying calls. Typically, when we're going to sell anything, it's as part of a spread. We'll do spreads by buying a call and selling a call, but we typically don't sell calls by themselves or puts by themselves. It's called a naked call or a naked put. I typically don't do that. I would recommend against doing it. Unless if you know what you're doing, you can sell naked puts to try to buy stocks at a lower price. I would never sell naked calls. It's a death wish to sell naked calls. All right, so when you buy something, you're either long a call or long a put. So when you buy a call, you're bullish. You're expecting the stock to go up. When you buy a put, you're expecting the stock to go down. So you go long by buying a call, and you go short by buying a put. Those are the main things that we actually do use. Again, you can sell a call and sell a put as well. So if you buy a call, you're bullish. You would be selling a call, would be bearish, extremely dangerous and extremely high risk. You typically can't do this. The difference between buying a call and buying a put is you have a defined risk. You can't lose more money than you put into the trade. All right? If you're selling a call or selling a put, you do not have a defined risk. The risk is basically unlimited. So you've got much more risk on when you do that. So when you buy a call, you're bullish. When you buy a put, you're bearish. That's the main thing to understand. Now, it is important to understand when you're trading an option, it's not like trading a stock. You do have rights and obligations on options. What that means is that if you buy a call or you buy a put, you have the right to buy that stock or sell that stock at a specific price, basically the strike price. If you buy a Microsoft $100 call, that gives you the right to buy Microsoft at $100, no matter what the stock is trading at. Now, if you buy a $100 call and Microsoft goes to 110, then you can buy the stock at 100 and then sell it at 110 or hold on to it. But that's typically not what's done. What you're going to do is buy a $100 call. If the stock goes up to 110, you're going to sell the calls and take the profit on the calls. But it's important to understand that there are rights and obligations. When you sell a put or you sell a call, you now have an obligation to supply that stock to the person who buys that put or call back from you. All right, so you're obligated to then go out and either buy that stock or sell that stock at the price that the strike price that you used to supply that stock to the person who's buying it from you. So you're under an obligation, and it's important to understand this. It may not happen to you, but you can get assigned. If you get assigned a stock on a put or a call, then you have an obligation to then give that stock to the person who bought that from you, and you have to usually go out and buy it or sell it at a much higher price than what you want to. All right, but that's important to know that. So what makes up an option premium price? So when you look at an option, it's made up of a few different things. And let's just take, for example, let's take a Microsoft $100 call. All right. Well, it's going to be made up of the stock price. If Microsoft is trading at $105 and you buy a $100 call, the stock price is $5 higher than the strike price you took. So that option is going to be worth at least $5. The stock's trading at 105 and you buy a $100 call, the stock price is going to be part of that, and it's going to be at least $5. Then it's going to also include implied volatility and time decay. The intrinsic value on a Microsoft call you're buying a $100 call, stock's trading at 105, the intrinsic value is $5. Right? So the option is going to be worth at least $5. It's excuse me, got to sneeze. Okay, sorry about that. So the option is going to be worth at least $5 if it's a $100 call and the stock's trading at 105. That's the intrinsic value. Then they're going to add in what's called implied volatility. How much does that stock move? Is it very volatile? So the market makers will add some additional premium to that $5 to cover the implied volatilities. So now instead of $5, that call might become $6.25. And then you have time decay added into that. And time decay is how much time is it to the expiration date? And what's going to happen is the options will go down in value if the stock stays flat. It will go down in value because the time decay will come out of it. There's a premium that's added to the option that keeps getting smaller and smaller as you get closer and closer to the expiration date, because there's less time for that stock to move to your strike price. So those are the things that make up the stock price, the option price: the stock price, the implied volatility, and the time decay. That's what goes in there. So this stock, if Microsoft's trading at 105 and you've got a $100 call, your stock option price is going to be $5, maybe $6.20 plus another dollar, maybe $7.20, depending on how far out in time you are in that option. So that's what makes up the option price. Okay, and the options can be, by the way, they can be at the money, as we've talked about. They can be in the money, or they can be out of the money. So to look in the case of Microsoft's trading at 105, and at the money call would be 105, and in the money call would be like 100, and out of the money call would be like 110. It would be higher than the stock price. Okay. So we just talked a little bit about intrinsic values versus extrinsic value. And I use a different example here, but if for the intrinsic value of a stock in the money price, so if you've got a $50 option at a stock trading at 55, it has an intrinsic value of 5, which we just talked about on Microsoft. So the intrinsic value is $5. Now, if you had to pay $7 for the option, the $2 extra is called extrinsic value. This is value of the options that's outside of the price, and that is the value of the option that can be reduced based on implied volatility changes or time decay. That's what's going to impact the price of it. So if you've got a $5, you got a $50 call on a $55 stock, it's always going to be worth $5 as long as that stock stays at 55. But the option price, if a week goes by and the stock's still trading at 55 and you had to pay $7 for the option, it's probably going to be down to about $6.50 or $6.25 because of the time decay that's been drained out of there. That's why option prices go down when a stock goes sideways. So that's what the extrinsic value is. That's the value over and above the intrinsic value that you had to pay for the option. And that is going to be have time decay and implied volatility adjusted to it. So you would, if you paid $7 for this call, you've got $2 that is going to be impacted by the time decay and implied volatility. So this is important to understand, because when you're buying out of the money call, let's say we had the stock was trading at $55 and you bought a $60 call on it, right? If you bought a $60 call, that's out of the money because the stock price is below the price that you bought the call. So now how much would you pay for that? Well, probably not a lot. This is one of the problems that traders run into. They buy the out of the money calls because they're cheap. So if the stock was trading at 55 and you bought a $60 call, you might be able to get it for 25 cents or 30 cents. I mean, it just depends on how much the stock moves, but it's going to be very cheap. So it's really appealing to a lot of stock traders, to a lot of traders, because they go out and get into this cheap. If it goes up to $60, I can clean up on this. The problem is all of that premium that you just paid for that option is going to be impacted by implied volatility difference and time decay, all of it. You've got no intrinsic value there at all. And the problem with buying out of the money calls and out of the money puts is, generally speaking, you can't make money at this strategy. It's going to lose them. Most of them are going to go to zero. And people are looking at them because they're cheap and they're looking for the big hit, but it's just not going to happen. So stay away from out of the money calls and out of the money puts. All right, the Greeks we talked about a little bit already, the delta, how much the option price moves in relation to the stock price. Stock moves $1, a delta of 50 means the option is going to go up about 50 cents. Now, if the stock moves up $1, the delta is going to move up too. It won't, when the stock moves up another $1, the delta is going to be higher than 50. It might be 55. So instead of moving 50 cents on the next dollar move, it might go up by 55 cents. All right, so the delta is going to go increase as the stock price goes up. But just to know that the delta that you buy it is going to tell you how much that option is going to move. Now the theta is the time decay, they call it theta. And this is the decrease in value of option price as expiration date approaches. And this is not a linear type of decay. Option premiums will drop much faster as the closer you get to expiration date. When you're 4 weeks out, the time decay is going to be slow. When you get 2 weeks out, it's going to be faster. When you get 3 days out, it's going to be extremely rapid. The time decay is going to come off of those options really fast. So it's not a linear move. It's more like a bell like this, where it starts here and just shoots down. So the closer you get to an expiration date, the faster that delta is coming out of there, and the faster the time decay is coming out. Okay, gamma is one other thing, and this is the rate of change in delta. If the stock moves up $1 and your delta goes from 50 to 52, or it goes from 50 to 55, it's delta. It's the gamma that's making that decision. The higher the gamma, the faster those deltas move as the stock moves up. So the gamma is going to be much higher on high volatility stocks. Okay, very very high. And this is kind of tricky. If you ever looked at a stock that moved up really fast in the morning, maybe it runs from $10 to $15 in the first half an hour. The stock's moving up really fast. What's happening is the gamma is going up really fast, and the option prices are going up really fast. In fact, sometimes they can go up faster than the stock price. It's the gamma that's doing that. But once the stock levels off and stops trading up like that, if it goes from $10 to $15 and then a half an hour later it's still at $15, the gamma has dropped a lot. Which what happens is the value of the option, which was really high at $15, is going to start to drop even though the stock price doesn't go down. It's gamma that's changing the option price at that point. All right. All right. So again, these are the primary primary option strategies. Steve, you're asking about price action. Yeah, well, I'll get into price action. I mean, price action is important, but what, again, as I said before, what's driving the price action is the most critical thing. Is it institutions or not? All right, so we use typically we use long calls and long puts, buy calls for long, buy puts for shorts. We do put credit spreads or call credit spreads. We do both of these. We do put debit spreads or call debit spreads. Another strategy. We do the calendar spreads I had mentioned, time spreads for over options. I don't call out condors in the room. I don't call out butterflies in the room. But these are option strategies. And then there's strangles and straddles, and I'll go into those. I do some of these strangles and straddles. Now this is kind of an interesting chart right here. This is bullish, bearish, and neutral option strategies. So when you like a stock, you can choose from a couple of different strategies to use, a few different strategies to use. If you're bullish, you can go long calls. You can go short puts, which again, I don't recommend. You can do put credit spreads or call debit spreads. These are all bullish strategies. The bearish strategies are reverse of that. You can be long the puts, short the calls, which you don't want to do call credit spreads and put debit spreads. These are your bearish option strategies right here. In neutral, what can I do if I'm neutral? Well, you can do a condor, which is basically a credit spread above the price and a credit spread below the price. Put credit spread and a call credit spread, but I don't use these. You can do straddles and strangles, which while you're expecting in these is the stock to make a big move, you don't care which way it goes. You just want to see a big move in the stock, right? And time spreads, which is the calendar spreads. This is what we use on earnings. These are non-directional. I don't care whether the stock goes up or down after earnings. I just want to capture the volatility change once the earnings comes out. And again, I have videos on all of these strategies, if you remember the room or the alert service. This is just briefly, we're going to go over the strategy setups. For put credit spread, you would sell a put and buy a put at a lower stroke price, receive a credit. Call credit spread, same thing. Sell a call and buy a call at a higher strike price, receive a credit. Debit spreads are just the opposite. You buy a put and sell a put at a lower strike price, but you pay a debit for it. You're expecting the stock to move down, but what you're doing with the debit spreads is you're actually reducing the total risk on the trade because it doesn't cost you as much since you've actually sold an option as well as buying an option cuts down on the price. Calendar spread, or time spread as we talk about here, we use the current week's expiration. So if we have earnings coming out on Thursday night or Friday morning, then sometime during Thursday we would sell a call for this week and buy a call for next week at exactly the same strike price to capture the implied volatility crush when the earnings comes out. Right, so you're selling current week's expiration call or put and buying the next week's call or put at the same expiration price. That's what the time spread is. Again, I have a video on that. A strangle is buying a call and buying a put, one strike or more out of the money. So if I want to do a strangle on Microsoft, all right, I'd buy a $101 call and a $99 put. I'm buying out of the money put, out of the money call, but don't care which way the stock's going to move. It's called a strangle. A straddle is if I bought a $100 call and a $100 put. I'm basically doing the same thing except I'm using the same strike price. That's what a straddle and a strangles are. All right. Now, when you're choosing options, when you're trying to take an option trade, right, the strike price, you want to use an in the money strike, as I had said. You want to make sure you're on a call or a put that you're in the money. So for Microsoft, if it's trading at 100, you want a strike price that's below 100 for a call and above 100 for a put. So if it's trading at 100, you want a 96, 95, $97 call, something like that. That's an in the money strike. The expiration date, you want to go up at least 2 to 3 weeks, even for a day trade. Even if you're trading and expect to exit the trade today, you should still go up to 2 to 3 weeks on the expiration date to mitigate or reduce the amount of time decay that you're going to have on that option as the day goes on. And if you have to hold it overnight, you don't want a lot of time decay, so you want to be out in time on that so you don't get impacted by that. The delta should be 65 to 75 or so on the option that you take. You want to take a look at the expiration dates and you want to take a look at the strike prices, find something that doesn't have a really big bid-ask spread, and look for a delta of 65 to 75. All right, so that pretty much covers options, the basic stuff. All right, and what I'm going to do is I'm going to run quickly through the results that we've had in the room and in the alert service since the beginning of the year. But a couple of things to point out here. Again, we do have losses just about every month. I think I've had 1 month with no losses. But it's important to understand what kind of profitability we get in each of our trades. If you're looking for, something that's going to give you 400% or 500% every trade, it's not here. You're never going to make consistent money doing that. But you can see what we get here. Our trades are, 43, 37, 10, 39, 21. They all run around reasonably usually between about 15 and 40%. We did have 96% here in Boeing, but this was January. This year was a pretty good month. We did 22 trades in the room, so not a lot of trades, but enough. 90% win rate. If you did invest $2,000 in each trade, you would have netted $7,500 basically in January following these trades. All right, February, similar results. Again, 24 and 2, 92% win rate. This was our best month this year, by the way. That was an investment of 2,000, produced 11,745, 26 trades. Again, percentages pretty much the same. 40, 25. We had a flat a scratch here. We had a 57% loss in Disney. But again, PayPal, nice 56. Very consistent across the board here. Some time spreads. But you can see the consistency, 80% AMD, but pretty nice. Now, I did break out the alerted trades this month. On alerted trades, we had 20 wins and 2 losses. So you see we had four additional trades in the room. But we had 20 down and 2 down here. The alert service produced 6,900, a little over $6,900 in profits on 2,000 on each trade. All right, so that's just something to judge it by. And I'll go into some of the more current months here in just a bit, but just to show you what the room is doing over the past year and a half or so. 2023, using 2,000 per trade. If you put 2,000 in each trade in the options room, it produced a profit of 60,000. Pretty good. And I do say in here, if you have a 50,000 account balance at the beginning of the year, you would have been using 4% of your account balance in each trade. Once you got to the end of the year, since we grew about 120%, your balance should have been around 110,000. So each trade at that point would have been less than 2% of your total account balance. I mean, you could have increased how much you want to put in a trade. So anyway, at the end of the year, 2,000 trade was less than 2% of the final accounts balance. So it went up by 60,000 from 50 to about 110. This is the first quarter of this year, 2024. In the room, 65 and 11, 86% win rate, 18,000 profit. Alert service, 41 wins, 6 losses, 87% win rate, 12,000 profit. That was January, February, March. April, May, June, 65 wins in the room, 14 losses, 83% win rate, a little low, but not bad, $14,000 profit. Alert service, only 35 wins. We didn't have as many trades, 6 losses, 85% win rate, 11.7 in the alert service. All right, so here's the May trades. Same thing, I don't have to keep going over this thing, but you can see the percentages run from 20s up to 70s. We have losses each month, 15 and 2 here, 88% win rate, 5,000 profit basically. Options 29, I'm sorry, this was the alert service. This was the room, 29 and 7, 81% win rate, $5,700 in profit. June trade, same thing here. I won't beat this to death. I just want you to see the consistency. In the room here, 25 and 4 for an 86% win rate, $75.90. And alert service, 14 and 1, 92% win rate. We actually made more money in alert service in June than we did in the room. Both pretty nice, actually. July, kind of same thing. Very consistent, 85 win. We did alert trades only 75. This is the lowest alert month I've had. 12 wins, 4 losses, but made $3,300. Not too bad. And here's August. This is the last one I've actually got. August we had this was so far, but this was room 17-2 and 8-1 on the alert service. Not a lot of trades, but nice win rates, nice profits. August was a choppy month. It always is. Everybody's on vacation. Market's kind of tough to trade in August. All right, questions here. Dan, so the more capital we have, the more total trades we could do. Well, that's not necessarily true. The more capital you have, the more money you can put into trades, but it depends on what your capital is. We can talk about things like pattern day trades. If you have less than 25,000 in your account, it limits the number of trades you can take each week. You can only do 3 full 3-day trades in a 5-day rolling period. But the more money you have in your account is basically what I look at it is you can put more money into individual trades. I typically don't have more than 4 trades on at a time on the alert service. Typically 4, 5 at the most. All right, so let's talk quickly about the alerts here. You're going to get, on the alerts, you're going to get the stock symbol, obviously, the strike price, the option expiration date, and the price to pay for the option. And that could be a range. You could say $1 to $1.05, or whatever. But you're gonna that's what you're going to get. That's going to come to. Now you're going to usually get at least 2 alerts on each trade. You're going to get one to get in, and then one for the exit price to take profits or to take a loss. All right. Scott says count size matters. Yeah, count size matters a lot. But if you're trading, your account size your risk is going to be dependent on how much you put into a trade is going to be dependent on how much risk you want to take. If you've got a $50,000 account or you get a $250,000 account, you can trade them both and do very, very nicely. With a $250,000 account, you can put more money into the trade. So the same ROI is going to produce more money. But you have to be very cautious about what your risk is. It's very important when you get into a trade. Just as an aside here, most people when they get into a trade, they think about how much money they can make on it. That's the first thing they think about is how much can I make? They look at the chart, they love it. How much can I make? When the first thing you should be thinking about when you do a trade is how much can I lose? What's my risk on this trade? Is the risk reward worthwhile? If I'm risking too much money, then you're not going to be able to stay in the trade as long as you want to, because if it goes against you, you're going to have to bail, even though the stock still may be bullish. So think about how much money is you're putting at risk. What is your risk on something like that? To be honest with you, when I take an option trade, my risk on that is the option going to a 0. That's what I think about. It could go all the way down. If I put $2,000 into a trade, theoretically I've got a $2,000 risk, and I've got to be comfortable with that. Steve says, make a plan and work your plan. I mean, it's absolutely true. This is what we're going to show you here is the plans we use to take all of our trades. They're all very specific. All right, so you're going to get an alert when we get in and an alert when we get out. And when you get an alert that tells you we want to sell it at a certain price to take profits, make sure you set it up as good till canceled when you put it in your trading platform, so that when the market opens in the morning, you can if the stock shoots up and you're not there, you get filled on it. You want to make sure you've got a GTC. All right, so I want to spend just a brief amount of time on how we get these stunning results that you saw. And again, I'm typically, my win rate is usually between 85 and 92% month after month. We've been trading now I started this room in January of 2022, so 2 years and almost 9 months, 2 years and 8 months. So the first 2 years and 8 months, or 32 months, we've had 29 winning months and 3 small losing months. 1 month was only $400 loss. So pretty good win rate. So how we do this? Well, we're able to identify institutions who are driving a trade and when the market internals are heavily bullish or bearish. And I've said this from the beginning. Identify when the institutions are in there, trade with the institutions. So we only take trades when both of these are in our favor. Not exactly true. We take trades when the institutions are driving the trade, as long as the internals are not going against us. If they're neutral, we'll go ahead and take the trade. And that's where we get to trade the best and skip the rest. Steve points out patience is a key. It certainly is. Patience is critical. All right, so how do we find these? How does the Compass system find these? What we look for and what we have what the software does is it does what's called a triple screen assessment. Some people call this fractals. It's multi-time frame assessments. We look at three different things. We look at the momentum, the trend, and the money flow. We look at these three things. And if the momentum, the trend, and the money flow are all going in the same direction on multiple time frames, then the chances that the institutions are driving this price action is extremely high, well up into the middle to high 90% that they are. All right, so that's how the Compass system does this. This is just kind of a graphic of the video of the Compass system. This is a Tesla chart, but I just kind of want to show you what the Compass system is. This is what the software produces. It produces these four different indicators down here. This is the key ones. Is this one here? This is the multi-time frame momentum right here, and this is the current time frame momentum. So when this is looking at a 5-minute chart, this multi-time frame momentum is looking at the 5, the 15, and the 45. It's looking at the momentum across those three time frames. This is the current time frame momentum. This is looking at the momentum across one time frame, just the current 5-minute time frame. Green and blue are bullish, red and yellow is bearish. This is the long-term trend, and this is a derivation of money flow. When I see all green like this, I know the institutions are buying the heck out of this stock. This is a very clear-cut situation where they're buying it. Up here we have some of the things that goes on here. This is the 15 EMA, this little thin green line. These arrows here the Compass system produces, these are called pop out of the box. These things produce an arrow when the compression is being broken. These shows you get compression being broken, and it's stock's coming off the 15 EMA. This is where we would actually buy the stock and then ride it up. And once it starts to show momentum loss, you get out. But this is what the Compass system looks like. You're going to see a lot of these charts here in just a minute. All right, so I'm going to talk about the SPY super system. And the reason I go into this is because I've got a lot of people who, they can't be in the room all day. And, sometimes I don't take a trade till, 2 o'clock in the afternoon. I haven't taken a new trade all day, but they want to be able to trade. So what I use is the SPY super system, which I've been using for a long time, but I haven't really promoted it in the room or done any videos on it. Now I have videos on it. So I started quantifying this the middle of July by putting 2,000 into each trade. Now this is where we're trading the SPYs, the Qs, and the IWM, the indexes off of a 5-minute chart. So July we had 16 and 0, 2,000 invested, produced 2,500 profit. Again, some of these are short-term trades now. These are not long trades. Some of these only last 2, 3, 4, 5-minute candles. August I did it fairly aggressively, 56, 6, and 2. 2,000 produced 8201. By the way, these numbers, these profits are not included in the ones I showed you for the room. These are completely separate. September so far, more than 9 trading days. This is up to this past Friday. 35 wins, 3 losses, 2 scratches. 2,000 invested, produced 6,500 so far this month. And these are trades that I've taken and I've talked about I called in the room. Some of the members in the room have taken them. Some of the members in the room have taken trades that I haven't taken. They found the setups and they take them because it's just focusing on that. I'm looking at several other things, other trades we have on. So that's what the SPY super system has done. These are quick trades and they're great for people who want to be in the room for short periods of time, short bursts of time, an hour, 2 hours at a time, come in the morning, come in the afternoon. And the nice thing about this is these SPY super system trades is only going to be one trade on at a time. You just have to manage the one trade, and they're going to be very short duration trades. So this is what the SPY super system has done. I'm going to show you some charts I'm a SPY super system with the compass system. Let me just get a sip of water here. Getting a little hoarse. Okay, so this was one we took, August 9th. Okay, so this is a SPY. This is a 5-minute chart in the SPY. And the chart looks really busy, but what I've done is highlighted the only things you actually have to look at when you're doing a SPY super system trade. First thing is the current time frame momentum right here. This is the only indicator that we use of these 4 indicators. It's the only one I'm looking at. I'm looking at the current time frame momentum right here. Notice that it goes from red, which is selling, to blue, which is buying. Remember, red and yellow are bearish, blue and green are bullish. We went from red to blue. Institutions selling, institutions buying on the 5-minute chart. I don't care what the multi-time frame is. I'm just looking for a quick trade. So here's the SPY. You can see that it's moving right along here. Now, this pink line here is the VWAP. All right, see, it says, hey, that's the volume weighted average price. This is a support and resistance level. This is a critical support and resistance level. I'm going to be taking trades either off this VWAP or off the 15 EMA right here. This is my support level and resistance level. The reason this is so important is when you take a trade like this, and we get in right here on this arrow as it went to bullish, it broke above the VWAP and the 15 EMA right here. I'm in this trade. What's my stop? If it closes below the VWAP. So my risk is really, really small. The downside risk is really, really small. So I stay in this trade as long as the stock stays above the VWAP, and then now the 15 that is moving up. So we stayed in this trade, and notice we keep getting these pop out of the box, so these pop signals for compression breaks. Notice that this went from blue to green. Everything is bullish on the 5-minute chart. No reason to get out. Stock's still moving up. This is where I start to see a little bit of waning in the momentum right here. The momentum has switched to wicks and tails. All right. So the momentum is very very strong coming up to this. These little green dots tell you that the momentum is at max, and then I start to lose that. And so this is where I get out of the trade right here on this little bitty red candle. Took the exit, and now that was we were in that for how many candles that was, maybe 50 minutes or something. $220 profit per contract on the SPY super system here. Again, it depends on how much risk you're going to take, but the risk was pretty small. And once they get above the VWAP, I would use the 15. And then you're watching. Once it gets extended, you're waiting for momentum to wane and then get out. So this was a good for $220 profit per trade. 10 contracts, which is what I usually take on these things, was $2,200. But if you took 2 contracts, you'd be up $440, and about an hour in that profit. All right. So that's one. So again, these just try to point out how few things you really have to watch here. This right here was another trade. This was on 8/23. This was a short on the SPY. All right. So this was a short on the SPY. Here's the VWAP again. See the pink line? You see how it's breaking below see the pop out of the box symbol, breaking below the VWAP right here. This is where I entered it. Notice that the current time frame was already yellow when we get in. It had already switched from bullish to bearish, and it went from actually yellow to red. So we were okay here because we know that they were selling. So this is where we get in. Now we had to stay in this trade for a while. Again, it was off the VWAP and off the 15. So the 15 becomes my line in the sand. My line in the sand for a resistance level, and it stayed below that. Notice it stayed below the 15. It popped above it briefly, but it didn't close it below it, and then it stayed below it, and then we got this nice flush. As everything stayed red across the board, and this is where I exited right here, $280 per profit per contract on that. But that was probably that's one of the longer trades you'll see on something like that. It started at about 10:20, 10:15. And went to about 11:45, a little over an hour. This was another SPY trade here. 220 profit. I think this is the actual, this is the same as the first one I showed, sorry. This was an 8/23 trade here. And this was the IWM, this is the Russell 2000. Again, notice we went from red to blue. We're waiting for a little bit of a break here above the VWAP, which we got right here. Pop out of the box symbol. Colors went blue, institutions are buying. We buy it here. We want it to stay above the 15. It stays above the 15, keeps staying above the 15, moves up nicely, get right out in this candle as it turns around. Stayed green the whole way, but that was good for $150 a contract. On the IWM doesn't move as much as the Qs or the SPY does. All right, and these are just a few more. I'll just highlight these, and we'll get into some other charts. But I just kind of want you to, where you can see these. All right, you can see right here. We go from red to blue. All right, so we're bullish. It's breaking above the 15 right here to the VWAP. I wouldn't touch this until it broke through the VWAP, because VWAP is resistance. Broke through it right here. Just took this trade and rode this one right up here. 4 or 5 candles and then out. IWM. Same thing. If you're looking at this, notice I'm not buying up here. I'm waiting for it to come down to hit this support level on the 15 and then buy it right here. It was already green, but I'm looking for a pop off of the 15. I want to be in close to my support level here, and then I can ride this one up. Same thing on the SPY here. I actually traded this both ways. I traded it short here as it went red, but as it broke below the VWAP for 3 candles. Then I get out, and then it bounced back above the VWAP, and it went from red to blue, selling to buying. I bought it here above the VWAP on the 15, and I ride this up. And I get out right here. This is a pivot point. It's on the compass system puts in the chart. This was an area that I was going to be resistant, so I exited on this candle right here. All right, and I can show lots of these, but I just want you to show the ease of identifying these with the system, and you have to look for them. You gotta wait for them. But you see here, green, buying, yellow, selling, breaking below the 15. Perfect entry right here. As long as it stays below the 15, you stay in. It keeps coming down, then you get out on this green candle right there. Another good one right here. This is where you would take it. As it was all green, wait for it to break above the VWAP. You can buy it right here or on this candle and just ride it up. It's only very few candles here. Small gain. All right, so those are the SPY Super System charts. I'm going to show you some additional trades. These are on the standard type of trades we take, the ones that are on the alert service, and the other longer term trades we take in the room. All right, so this was a Lulu. Now this is, we look at more indicators here. We're looking at Lulu. We're looking for a breakdown here on Lulu, and we had a nice overnight breakdown. But you notice how everything here is yellow or red. So this is what we want. We want these aligned when we're taking a longer term trade. We want the multi-time frame momentum and the current time frame momentum to both be bullish or bearish, yellow and red, and they were both bearish right here. We actually took it here off of this compression when this went blue, went to yellow. We took the trade right here, and we took this just overnight in for $1.92, out for $3. But again, we're using these 2 indicators more than anything else right now. Multi-time frame momentum, current time frame momentum. Steve, set an alert and go play. Yeah, I mean that's fine. It's the alerts on the SPY system, on the SPY Super System. Yeah, you can set alerts at the VWAP. I mean, I have a scan that looks for stock breaking above the VWAP or breaking below the VWAP as an indicator, and I can look at it, and then I can see what my compass system is telling me at that point in time. This was workday right here. Again, this shows this arrow's off when I actually get in right here on the blue. It went to yellow. I have to be very cautious when this happens on the multi-time frame. And the current time frame was blue the whole way. This is a daily chart, but we were in this trade for 5 days. As long as this stayed blue and the price action looked good. I mean, the price action was very nice on this, so I stayed in the trade and I wrote it up for 5 days for 30% profit. This, by the way, if you're wondering about this shaded area, this is what's called a dynamic compression zone that the compass system produces. GCT, this was a nice 2-day trade for 26% gain. Everything's green. Institutions are buying. It pops up here. We take it right here off of this compression break, and we ride it up for a 2-day trade and make 26% on it. Options give you, options are nice for leverage. That's why you can do so well in options. This was MDT for, I don't know what this J is in here, but on a swing trade. Again, we've got right here. Notice how this went yellow on the current time frame momentum, and the daily went to blue. Went from selling to buying. Multi-time frame was already buying. Perfect place to take it right there as it's coming off the 15, and we ride this up and we get a nice little pop toward the end. 25% profit on that. VKTX, nice profit here, in here, out here, again, all green, just looking for a break. This was an overnight trade that we get in here and out here. $8.30 we get in at, 11.30 on the outside. When we left, 37% gain. Again, everything's green, and we're looking to see this dynamic compression zone. It broke out of that dynamic compression zone. The stock was compressing, and we get in right here, we get out right here. McDonald's. Amazon, another nice one. This is a 5-minute chart. This was coming off the 15 right here. Everything's green. All the multi-time frame and counter time frame are green. Coming off the 15 EMA, could have got it in right here, but it was yellow. So waited until it went green, bought it here, and 45 minutes we're in this thing and made 32%. ENPH, another 20% in an hour. Notice the nice, see how red it is? I mean, anybody can see that the institutions are selling this. Really, really easy. And you can see this pop out of the box as it comes off the 15 right here, and it comes down. Very similar to what the SPY Super Systems setup is, by the way, on these stocks. Coming down, and 20% an hour on ENPH. Verizon, 50% in an hour. Get it right here as it breaks below the VWAP on a 5-minute chart. Pop out of the box symbol, everything red. These options were very inexpensive. We paid 45 cents for them, $45 a contract. We get out an hour later for $67 a contract. So $450 turned into $670. $450 turned into $670. Right, and again, this was just another SPY Super System trade, just to see that's coming off of the 15 right here. Everything red, beautiful trade in this one as well. Right, so that's kind of the setups. This was a Tesla trade. We took this overnight. We're off the 5-minute chart, but we had to pop out of the box at the end of the day. Everything was yellow or red. We took it overnight. We got a lucky break, and the stock gapped down $8. And so the puts went exploded in value. Okay, so that kind of covers all the things I wanted to cover. Again, these are the strategies we use in the room. As I've covered these, SPY Super System is in the room. It is not on alerts. And this is the offers that we have for anybody who was looking to join the alert service. This is the alert service right here. Quarterly for $396, annually for $992. Lifetime, I've had some lifetime folks for $24.96. Now, if you get the alert service, you get a month in the room for free. We have a Discord room where we have 2 other professional traders that post trades, post charts, give you a lot of information on economic information, sectors, etc. Also, the video library on all of the videos, I've got about 30 of them on all of the different strategies we use. First 10 who sign up today will get 2 weeks for free. If you take the Compass Alert Service, you get in the alert service for 2 weeks for nothing. If you want to try that. Most people stick with it. 2 weeks isn't very long, but it gives you some indication. All right, so this is the actual alert service. Now, if you're interested in the room itself, 50% off on these things. Again, $11.98 for a full year. You can try a month for $148 if you want. It's kind of to me, it's too short a time to make a judgment. But again, you'll be in the live trading room. Obviously, you'll get the Discord instant messaging room where you can go in there and see all the trades being posted, work with the other 2 professional traders, and again, the videos you get. So this is for the actual trading room. This is if you want the SPY Super System and you don't want to have the software, this is where we'll talk about them in the room. I can't do them on the alerts. And the Compass trading system itself, if you're looking to get the actual software that we just looked at, the Compass trading system, $14.98 for a year, $19.98 for a lifetime license for that, the Compass system. Again, this would be, if you want to do the SPY Super System yourself or take trades yourself, you can use this. And now you're going to get what's called my workspace. It's going to look exactly like the charts we were just looking at. It's going to have all those indicators. I have a bunch of scanners. You get all of those scanners as well. And again, you'll get if you take the Compass system, you'll get a month in the trading room. And you'll get the Discord. and the text alerts, and you'll also get the videos on how to trade all these different setups we've got. I've got the videos are very detailed on each one of the setups and structures that we use, and you get the trade scanner. So this is for the actual piece of software, and that's what I use all the time. I tell you, it made a big difference in my trading when I discovered this about 3 years ago. Moved my average win rate from about 80% to about 88%, which doesn't sound like much, but it's a big deal. All right, so those are your offers. The Compass Alert Service right here is a 2-week trial for the first 10, $396, $992, and lifetime for $24.96. And you get a month in the room if you get the alert service, as well as the Discord and the videos. And there is the options room itself, where I'm in there every day, by the way, from market open to market close. I go in about 9:15, talk about trades. I'm there in the open, and I stay there till market closes, talking about trades, answering questions. People post trades all the time they want information on. I show it to them on the Compass system. I show it to them on my TC2000 chart. I go into technical analysis on each one of the trades. So I do a lot of education in the room, a lot of education in the room. And there's the Compass trading system itself if you want to get the software. All right, and all of that information is in the chat box, I believe. And there's a link in the chat box to each one of those offers, so you can click there. If you have any questions, you can call Rory at 786-732-4656. And let me see what else we've got here for questions. Carol, Long, how far out do I take the options trades? Typically, even on a day trade, I'm going to go at least 2 weeks. Typically, I'm going to probably go out, somewhere around 3 to 5 weeks on the option trades. I don't want to be suffering from time decay too much, because if the stock's kind of compressed for a while, I don't want the options to drop much in price. So, typically I'm going to be out 3, 5, sometimes even a little bit more than that. Do I trade oil or gold? Yeah, I do, Dan. And you can trade anything you want off the Compass system. If you put the oil, if you do the /CL, or you put your gold indicator in there, for the futures, you can trade you can trade those. The Compass system is going to show you the results for any particular thing you put in there, not Forex, but all of the ETFs. All of those would be tradable, and I trade them sometimes if they're good. I'll trade them. Typically for ETFs, I stick to the SPY Qs and IWM, but a lot of people in the room trade gold. They trade precious metals. They trade oil. You can trade anything. Steve, appreciate that. Thank you very much. Edward, do you set stop losses ever? I have been part of the free trial. I noticed that some of your losses are large. Of course, that is outweighed by the winners. Yeah, I typically don't. I don't ever set. I'll put like what's called I'll just put an alert. When I get into a trade, I'm getting in on the technicals. When I get out, I'm going to get out of the technicals. Can the stock go against me? Certainly, but I'm going to stay in the trade as long as the technicals tell me that the stock is. If I'm in a bullish trade, the technicals tell me it's still bullish on the daily chart, then I stay in the trade. If it goes against me and I can't do anything about it, then I'll get out. And you do take some larger losses when you do that. But here's the problem: if you take a specific loss at a specific percentage loss, a dollar loss, for example, I get into a trade, I'm only going to allow a 15% loss, and I'm going to get out. So you're getting out of a trade that may still be bullish. What you're doing is you're taking away a potential winner. So you're going to reduce your win rate by quite a lot, and you're not allowing yourself to let the stock breathe. So it's all technical to me. I don't trade price. I don't trade my P&L. I trade the exact specific technicals that I see on a stock. Can they go against you? Of course they can. And a stock can compress for a week, which is going to reduce the option price on that. But do I want to get out if I've got a bullish stock that's in a bull flag that's compressing? I don't, because I'm waiting to see if it's going to bounce. If it doesn't, I take a loss. But if it does, I take a profit. And that's the way I trade. Do I trade currency? No, I don't trade currency. I used to trade Forex, but I don't anymore. Any stop losses daily in the SPY super system? Well, the SPY super system, as I had showed you, you're getting in right at the VWAP or right at the 15 EMA. Those become your stops. So most of my losses on the SPY super system are really small, somewhere in the 10 to 30 cent range. Typically, I'm not going to stay in if the stock closes below my support level. Now, if you get a big flush down red candle or something, that can hurt you. But typically, if you know what a profit factor is, the profit factor on the super system trades is over 6, which is really, really high. I mean, if you've got a profit factor of 2, it's really high. Profits factor of 6 is astronomical. That's because most of my wins are going to be anywhere from 30 cents to $1.20, and there's a lot more of them. Again, the win rate is about 90% right now, and most of the losses are going to be really small on the SPY super system because you're only entering right there at support. Do buy at the money all the time? Carol, I buy in the most of my option trades outside the SPY super system are in the money. In the money, a 65 to 75 delta. When I'm trading the SPY super system, I'm typically buying one strike in the money on the SPY or the Qs or the IWM, one strike in the money. And I'm taking, before 12 o'clock, I take 0 DTE. I take today's expiration. After 12 o'clock, I take tomorrow's expiration because I don't want time decay to impact the options too much. I go into a lot of detail on that. So you can see that you get out in an opposite candle. It makes sense. Yeah, I mean, the SPY super system, again, you know, I don't like, a lot of people don't like to do quick trades, but this thing is for somebody, they come in and people are in the room and they get bored. And I know traders get bored. That's why I say patience is so critical. This is kind of a panacea for bored traders who want to trade and are willing to at least wait till the SPY, the Qs or the IWM sets up for them. Yeah, patience makes sense. It's absolute patience. It's key. I mean, I think one day this week, Wednesday or Thursday, I didn't take any SPY super system trades at all the whole day. And the reason was the SPY price action was terrible. It would go above the VWAP for a half a candle, come back down again. When you're just chopping around like that, you don't have anything to go by. And I'm always watching the market. I always have the SPY up there so I can see what the market's doing. Market action is critical to any trades that you take, because if the market action is you're in a trending day where the market's moving up or moving down consistently during the day, you're going to have much better results on a day like that. Choppy action, I cut down the number of trades I take profits more quickly. You just can't ride with them as long. Steve, you do trade currency and do well, good. Yeah, a lot of people do trade currency. I don't, but I mean, a lot of people do, and they do very well at it. And, you know, if you're a trader, you're a trader. If you understand technicals, it doesn't really make any difference what you're trading. Technicals are technicals. Steve, getting bored, that's why you set alert and go play. Yeah, it's patience, and that's good. I mean, that's really good. You know, you get very tempted if you're sitting in front of your screen to trade. You from the EU and not only just trades is futures MES. Yeah, that's fine. You can trade the futures. You can trade. You know, if I'm showing the SPY over here, I could just as easily show you know, the ES or the NQ or the RTY. I mean, they trade the same way. You can use the SPY super system on those futures. Works the same way. Steve, your uncle is Warren Buffett. Happy to hear it. Taught you well. Yeah. Well, listen. You know, and you know, Warren Buffett's not a trader; he's an investor, and you got to make sure you separate the difference between investing and trading. When you're investing in a stock, you're looking at the fundamentals on the stock. As a technical trader, not an investor, as a technical trader, I'm just looking at the technicals. I'm not looking at fundamentals. You know, when I look at a stock and somebody looks and they see, you know, they signed a new contract, they've got a bunch of revenue likely to come in, in the next year or so, then you look at the stock and say, okay, I want to buy it. I want to hold that stock, right? I don't care. I'm just looking at what's the price action on that stock right now. Is it likely to go up for the next week or two, or to go down for the next week or two? Because I'm not going to be in that long. My time frame is much, much shorter. Most of my time frames are a month or less. So fundamentals don't make that much difference to me. I mean, I do watch news and trade off of news sometimes. If a news event comes in, it's going to drive up. If you looked at Intel, it took a big bounce yesterday afternoon when they're talking to Qualcomm about merging. Big pop in Intel. Those can be quick trades if you know how to trade those. A lot of times I'll do straddles and strangles on those kind of movements. But yeah. So anyway, that's how I trade. But you can trade the Compass system on anything. You can put anything in there that you want. It's not Forex, but you can put any futures contracts in there you want. You can trade gold stock, gold futures. You can trade oil stocks, oil futures, anything. The setups with the indicators are going to be exactly the same, and you can trade exactly the same off of the VWAP and off of the price action on any particular instrument you want. Steve says, watch what Elon's doing. Yeah. Well, I don't know. He bought X. That wasn't too good a deal. Anyway, I trade Tesla a lot, by the way, Steve. It's one of the Tesla's a good stock to trade once one gets into a pattern, because the options move a lot. I mean, I like to trade stocks like Tesla, Apple, but we also trade a lot of blue chip stocks. Coca-Cola, Bristol Myers. We'll trade some stocks on biotechs, things like that. So we take every now and then we take a speculative, riskier type stock that can make a big move or pull back, but we don't risk a lot in those, and I highlight them very clearly when they're a speculative type trade. All right. So listen, I'll wrap it, everybody. I know it's been a long afternoon. I appreciate everybody with all these great questions. Steve, thank you for all your input. Appreciate that. And I look forward to seeing some folks in the room on the alert service here pretty soon. Again, there's links in there, and you'll get a replay on this video, and look forward to seeing you there. So listen, have a great weekend, everybody. We'll see everybody on Monday.